management of TCI Express. Then Chander Agarwal is the managing director, joining in to talk a little bit about the impact of the fuel rise on margins as well as what the outlook is in terms of demand. Mr. Agarwal, good to have you on board. To begin with, we have seen that rise in diesel prices. How do you plan to mitigate the same, and what kind of price hikes is the company looking to undertake?
So, this is not the first time that we've seen a diesel fuel hike. It's been an ongoing process in India. I think since GST was introduced, I think the fuel price was being hiked on a daily basis. So this is something which, we are quite accustomed to, and we have found our ways of, maneuvering around that by talking to customers. And also we had introduced the diesel fuel surcharge. So that really helped in, balancing out these day-to-day daily shocks, as I must say. So fuel hikes, price hikes. So I think we're quite immune to that. Of course, it's a passover also to the customer, but the way a company can do it is also very critical in achieving that. So, we have our own branches, we have our own manpower, and that's really beneficial in bringing out that increase with the customers.
Okay, fair enough. And Chander, how are you looking at the outlook for the industry as a whole? Because clearly macro indicators seem to suggest that the logistics industry has now reached the pre-COVID levels. Is that a sense that you're getting, that things are now back to normal?
Absolutely. I mean, we're doing phenomenally well. And I think the important key points is that, first of all, our business, TCI Express business, is driven on the economic growth. So next 10 years is poised to be a phenomenal growth opportunity for TCI Express. And not just, and in the short term, as we look at, the COVID has gone away, and then, and then we're not having so much of all these lockdowns and everything. It's a much clearer path to better top line and bottom line growth. So just to give you an example, for the 10 years, I have TCI Express will have an EBITDA of about almost 3,500 crores and PAT levels of 2,000 crores, and out of which we will be investing 1,000 crores in the next 10 years. Now, all this will be through internal accruals. Nothing is going to be on debt. So I think that itself shows that, it's a good place to be in, and the business is going to be prospering as we go along.
Yeah, this is Nantara joining in. I would ask you one question, because you were talking about EBITDA, right? And the kind of how you're funding everything from internal accruals as well. So you have a good balance sheet, and we've been reading about that from Jefferies and other brokerage reports. How are you going to continue compete with companies like a Delivery, a Shiprocket, a Picker, or a Page, which are backed by venture capital, have raised serious bucks, as of now are not listed, so they're only responsible to the venture capitalists and other shareholders, and they don't mind burning big bucks and big capital?
So, logistics business is not about big bucks. It's about knowledge. So who has the knowledge? It's about the intellectual property. So essentially, with the background that TCI Express has, we have the intellectual property, which is worth probably $100 billion, if I have to say. So I don't think it's a quotient of how much money one can bring in, because just to give an example, you had the MNCs of the world, they're operating in silos in India. Why didn't they come here with in full swing? They have been operating in silos for the past 20, 30 years. So this is something that, is not going to be easily achievable. I mean, yes, you can have top line growth. I can do top line growth of 20, 30,000 crores, but and have a bottom line of, whatever, negative 2-3 thousand crore. Would my shareholders be happy about that? Possibly not. So I think I'm not really disturbed by what they're doing, and on the ground, they're not really giving me competition.
I'm going to ask you one question, and this is again from a influential foreign brokerage firm, and I wanted to get your views on it. It says that the stock has re-rated over the years, but is yet to fully reflect a sustainable 30% earnings growth with 25% plus ROE business model. You're talking about the business model. You decide to stay in B2B. You don't want to be in B2C. Your top client concentration is also pretty good when it comes to the revenue mix. So why are we not seeing the reflection then?
So the reflection is there. I mean, if you look at it, CAGR growth or the ROE and the ROCE. So the company listed in only 5 years ago. It had the track record of getting that, financial ratios, what you're talking, for not just now, but for the past 15 years. So this is something which has been static and has been stable. We're already at achieving about almost 40%. We will be achieving 40% going forward, EBITDA growth levels. And I think that is something which, the market will see also.
Okay, Chander, so that's the word coming in on, why or when will we see that 30% growth come into the picture. But, a couple of future triggers that the street has been talking about is, of course, your newer segments like cold chain and your servicing to the pharma sector. How's that shaping up? And also, if I understand it correctly, you were also looking at automating your sorting centers, and that was expected to reduce the throughput time substantially. What's the update on that?
Sure. So the sorting center is in its trial runs, and I think it's going to be quite glorious when we open it up to the public, with photos and videos and all of that. So, it was started only in the month of March. So I think in full swing, it'll be operational by end of May. Sorry, end of May. So that I think the real benefit will start seeing in Q2. This is something which has never been done on this scale, and later when I'm in Q2 when I talk about it, it'll be quite interesting to see that.
Okay, Chander, and what about? Sorry, please go ahead.
So the new businesses, of course, the cold chain is a very small proportion. Let's not forget the C2C, which is growing phenomenal, and which is growing like almost 100% year on year, and the rail business, rail B2B business. So I think, it's only a matter of time. We started that business last year, and we'll see the benefits coming in. Like I said, 10 years, 3,000 crore, 3,500 crore EBITDA, and 2,000 crore PAT. So I'm quite confident about that.
Big numbers coming to you from the management of TCI Express. But before we let you go, Chander, quickly a word on your Capex plan as well, because the focus was on creating a pan-India presence, and there was a next leg of Capex cycle expected with an investment of 400 to 500 crores. What's the timeline that we should be looking at, and what will it do to your balance sheet and your debt as well?
So we don't have debt. We're a debt-free company. Everybody knows that. And it's all through internal accruals. The investment is intact. It's all through internal accruals. We will be investing about 1,000 crores in the next 10 years, 500 crores in the next 5 years. So at the moment, our financial ratios are also very good. Our return on equity is about 25% plus. So I think it's all in place. This year already, we will be investing about almost this year, meaning last financial year, we invested about almost 80 crores. And going forward this year, we will be investing about another 120, 130 crores.
Okay, Chander, we'll let you go on that note. Thank you so much for making time and speaking to ET.